Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti here from My Time Equity. In today's webinar, along with Sudhir Pai, we have Anup Nayak from My Time Equity with us. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through this disclosure slide, which our attorneys mandate that we show in our webinar every week. If you have any questions during the webinar, you can just type them in the Q&A box and we will take them in the Q&A section. And also, if you need Sudhir's help, please write to us at wealth@mytimeequity.com or call us at 972-330-2771. And also, in a couple of slides, we have the QR code which you can scan and join our WhatsApp group for getting the day-to-day market update. Over to you, Sudhir.
Thanks, Jyoti. Can you hear me?
Yes, we can hear you.
Okay, wonderful. Okay, great. Thank you, Jyoti, and thanks, Anup. Good morning, folks. This is Sudhir Pai. So regarding markets, the topic of this webinar, apart from the market update, we kept it as rally or retreat, and we came up with this, title before the whole missiles got launched by Israel on Iran. So I think the topic still makes sense. We'll talk more about that. But coming to the update of the equity markets and crypto markets for the week, we saw a sharp pullback on Friday because of these geopolitical tensions. But for the week, we saw a positive, week for a few things, particularly gold and Bitcoin. Both safe havens did well, but Bitcoin really took a big beating, on Friday, because it plays the role of a risk on asset like equities, and sometimes it behaves like a small cap, sometimes it behaves like large cap. So Bitcoin also took a beating. Now also keep in mind that whenever there is such a big rally, almost a few points away from all-time highs, there will be some correction and sideways movement, and that we'll have to tolerate patiently. Now coming to the S&P 500 and Nasdaq 100, we saw declines for the week of 0.4% and 0.6%. And the biggest winner for the week was oil. It jumped to almost 14% on Friday in the pre-markets and ended the week with almost 11%. Platinum was up almost 4%, and gold about 3%. Silver, I think, took a little bit of a breather because it did very well the week before, and that's about the commodities. Now the tensions in Middle East, with all the war going on between Iran and Israel and Iran, there are a lot of uncertainties. We have to see what happens between today and tomorrow. Today's news was that some of the bombing that took place did not completely destroy Iran's nuclear base. So we don't know what kind of retaliation could happen against Israel and also maybe US. Let's see how the weekend goes and beginning of next week. And on the tariff front, we saw a lot of tweets coming from the White House and President Trump that the Chinese tariff deal is kind of coming to a close. And for others, they may postpone the date for the pause of July 9th to another 60 or 90 days. So all of that means either there is more time for countries to sign up a tariff agreement with US, or some of the countries are actually finalizing their tariff agreements with the United States. So the trend is not broken. We are still, above 200-day moving average and above 21-day moving average, which represents momentum in the stock market. So the next week, we will see Jerome Powell coming to the forefront and speaking about, FOMC's decision as well as inputs about what they think about the inflation reports and the jobs report and the market as a whole. So overall trend is in, we are 100% invested in the equities long right now, and I suggest we take every week as it comes and decide, our actions. Next slide, Jyoti. Okay, so rally versus retreat, what is in it for us for 2025? So if you look at, what has happened in the past, because that's the only thing we can take into consideration while making a decision of such an uncontrollable, unknown, large market like the equities market, where there are so many players. We look at seasonality and we look at historic numbers and we see what had happened in the past. So if you look at the two, big correction that took place in the recent past, which is the 2020 COVID and 2018 when the S&P had a sharp fall of 20% plus. So we saw, the rebound happen very sharply, in both 2018 and 2020, and we saw the same thing in 2025 also. So, while COVID is a black swan event, 2025 also can be looked like a black swan event, which means it's kind of a created one where White House came out and showed that big board and, said that US is changing its stand from what it used to be to what it is going to be, more of a country that will try to make money out of tariffs and duties by charging taxes to other countries for the amount of money that we spend. So that's a completely a different way of looking at the world by the US. So if you look at even that as a black swan event and the correction, market getting into the bear market territory of more than 20%, all of this is corrected by a V-shaped recovery. The correction just happens, at the blink of the eye. You never know how it will happen. Pre-markets, it will just go up and then it will continue to go up and the losses will be covered. So, what does this mean for the future from here on, right? So let's look at the chart on the next slide. Next slide, Jyoti. So if you look at what happened in 2018, we saw a sharp decline in Q4 of 2018 after President Trump's first version of tariff was launched or released in 2018 when during his last presidency. And we saw that V-shaped recovery then as well, a huge boost to the market. And then what happened? Then you saw a 8% correction, after it touched the all-time high. So if you look at the peak, of the 2018 numbers in October 2018 to May 2019, it saw the same level after that V-shaped recovery, and then it had a 8% drop. So what this means is that we can see anywhere between 8 to 10% correction between now and the next rally that might take place. Okay, past performance is never an indication of future, but that's the only thing we can consider, while doing our analysis of what might happen, because nobody has a crystal ball, and stock market is all sentiments of people, sentiments of algos that trades on the market, the sentiments of hedge funds, all of that, right? So looking at that, you can clearly see that there was an 8% drop, and we can expect something like that in 25 also. And we look at what happened in 2020 after the COVID drop. So again, if you look at this slide, it looks the same, right? Just it looks like as if the dates have changed, but no, this is 2020 chart. It has dropped almost 35%. It came back up, within few months, and then it saw a pullback of 10%. But you see that it touched the same all-time high and then went up a little bit more in the month of August 2021, and then it started the correction phase, because traders usually want to take some money off the table. They will want to exit and they want to take the money off, and Also the algorithms and all the hedge funds. By the way, we do have access to very high quality hedge funds. If you want to invest in a hedge fund, you can invest in the equity market in three ways. We keep talking to you about direct investing versus structured notes. Now there is a concept called hedge funds. Millennium is one of the top hedge funds. Bridgewater, which is run by Ray Dalio, is another top hedge fund. So we have access to Millennium. We have access to another hedge fund called Verition. This hedge fund has consistently delivered on an average of 12% over last 20 years. So there are companies, there are institutions and managers who know how to play the market, in an up market, in a down market. We are not that firm. We are long-term investors, but we have access to hedge funds. So let's say you want us to manage $1 million of yours, we can put 500K in managing it ourselves and 500K in managing it by these hedge funds. So because the returns are pretty stable, and you don't have to be concerned about these kind of drops and V-shaped recovery and all that, because V-shaped recovery is great for long-term investors. But what happens if you need all that money when that drop happens? If you're buying your primary house, or if you're having a need for your kids education, or you have to send money to your parents, or if you lose your job and things like that. And this happened, by the way, during the dot-com bust and during the global financial crisis. People lost their jobs, and the stock market was down by almost 40-50%. So it was havoc, right? All the money that you saw on paper vanished, and there was a big concern. So protecting your money against such drop, if you are in that age group, or if you have a need for that money in the short term, is very important to know where to park that money. So that comes under financial planning. So if you want that help, we can help you there, right? But if coming back to this, V-shaped recovery in 2020, what happened, after the market touched the all-time high, and after that there was a 10% correction, again a little bit of upside, then again down. So it was kind of sideways movement, and then it started again, picking up all the way till February 2022, 2021. So this is how it happened. So hopefully we will see the similar kind of an uptrend for this year. All the indications are great, except for these geopolitical tensions and the tariff concerns. The earnings of corporates are very good. S&P 500's overall growth of all the companies is around, net income growth is around 14%, revenue growth is around 5%, and 76% of the 500 companies have beaten their estimates. So results are good, inflation is falling, jobs are pretty strong, still not showing any weakness. So with all that, this represents just the price action. This means this is how markets may react, because there are too many players in the market. And so look forward to this correction of anywhere between 8 to 10% based on our analysis of 2018 and 2020. And don't feel panicked if you see that correction. And we saw that happen on Friday pre-markets. S&P was down almost 2%, Nasdaq 2.5%, IWM was down by almost 2.8%. Bitcoin was almost down by 4.5%. So but during the day it recovered, and it was not that bad by the close of the day. Coming to what are the hedge funds doing? As I explained you about the hedge funds are those funds which take money from investors. They manage the money for you, they charge fees, and they play a very, very smart game of shorting the market, which means selling it when the market is high, buying it when the market is low, or they go long, they do options, they have multiple strategies. So this hedge fund Verition that we use, they have 105 strategies. The minimum to invest in that is $100,000, and you can invest in hedge funds only if your net worth is more than $2.2 million. So if your net worth is less than $2 million, they won't let you invest in their fund. And some funds also need $5 million net worth. So that is who hedge funds are. All the billionaires park the money with hedge funds, and their money is growing nicely, steadily. They don't look for 30-40% growth. They look for consistent return, beating the S&P 500. S&P long-term return average is around 10% after dividends. So if you're getting anything more than 10%, it makes sense to invest in some of these hedge funds. So if you look at how hedge funds are doing, hedge funds have been behind. They were really taken for a surprise, when the COVID V-shaped recovery happened, because COVID really changed the world, because people were sitting at home. Robinhood, the kind of tools evolved. The buy sell button was very easy to click, and education was easy to get through all the influencers and YouTubers, and we saw a lot of money from retail coming in the market. And last but not the least, the government also printed almost $9 trillion of money, and that put a lot of money in people's hand, and all that money came to the market, and that really gave the market the V-shaped recovery. And we saw the GameStop squeeze in 2021, and all of that happened. And very clearly, retail is in control, hedge funds are behind, but hedge funds do very well in the times of volatility, which means market kind of behaves very, very erratically, for geopolitical tensions, tweets, news, and all that. And that's what is happening. And our current president, is very good at that. He keeps tweeting. You saw Tesla fall down by almost 15%, recovered most of it. So right now it's all about market going up and down, up and down, up and down. So right now hedge funds are coming back. Okay, so right now hedge funds, which did not do well in the last 2 years, because the market was only going up, there was no up and down, up and down, there was no V-shaped recovery, there was no downside, it was only going up because of Max 7. But now hedge funds are coming back in, and they are going to play their games, right? And right now they're sitting on the sideline, and we are seeing the pickup of the hedge funds putting back money in the market. And that's why I'm also telling you that it might be the time to invest money in hedge funds, because hedge funds always make money for them and for their investors. And if they are coming back, there is a reason for it. And we have access to great hedge funds, and this also means that markets are going to do better, but markets will also continue to be volatile, because if the players are like traders, are like hedge funds, are like algos, you will see the market really pump up and pump down. So it's very clear about that is what will be happening in the next second half of the year. Next slide. Okay, so in all of these, who is participating? Is it only the large cap? Is it international equity? Or is it only the Max 7? Or is there any participation by the small caps also? So coming to small caps, I would suggest you don't put your money in this without the advice of an advisor, or where you take a lot of time understanding the fundamentals of the company and how the market behaves, because small caps are very sensitive to everything. As I said, overnight on Friday, market dipped for small caps almost 3.5-4%, right? Same thing happened with Bitcoin. So right now, Bitcoin, small caps play, a very, very dangerous role. So you have to be very careful with it. But there is a lot of upside in small cap, because if you look at small caps, the earnings expectation, for 25, rest of 25 and 26 is pretty high. But then, if you look at the valuation of small cap, it is already trading at almost 24 times of the future earnings of these companies, whereas S&P is around 22 times, which means all the companies that you buy, on an average of all the S&P 500 companies, you are paying them 22 times for S&P 500, and you are paying them 24 times. That means these companies have to earn 22 years worth of return income. That is what you are paying them for that today. And companies like Palantir, companies like Tesla, these guys are trading at mind-boggling numbers. So what does it mean for small caps? Small caps have a lot of value in them, because their earnings potential is high, and interest rate reductions will help them further in increasing their revenue, so net income, and all of this can really give a pop to the small cap companies. But then it's also very sensitive, because people run far away from small companies. If it is an Nvidia, you are very confident, $1 trillion company, very strong, nobody can really screw them around, nobody can really compete and take over their business that easily. They have kind of monopoly in the market. So large caps are more stable, strong, and US markets have been very, very strong from the last 15 years. So if you're trying to get into small cap, please be careful, but there is value in small cap, and we do have, a little bit of small caps in our client portfolios all the time. Next slide. So coming to what's going to be the news for next week. And by the way, there is a QR code on the screen. If you have not yet joined our WhatsApp group, this is a one-way WhatsApp group. Nobody can spam the WhatsApp group. It's only one message a day, two messages few days, that gets posted there. So if you have not joined our WhatsApp group, please use your camera, scan the QR code, add yourself to our WhatsApp group, and you will be getting a lot of education from there and also a lot of opportunities. And all these links, about our webinar, about the recording of our webinar. If you missed the webinar, you can always go click on that link and see it in the evenings or in early mornings during whenever you have time. And you can also forward it to others if they want to get education about what has happened to the market, what are the opportunities. So feel free to join our WhatsApp group. Now coming to the news for next week, it's kind of a slow week because Thursday is a holiday for the market. And then FOMC projections on Wednesday is a big thing. We have to see whether Fed is going to stand strong and behave the same way that they have been behaving over the last 1.5 years, or are they going to hint any possible rate reductions, or they actually go and cut the interest rate. So we'll have to see what Jerome Powell would say, right? And that is on Wednesday. And so you just think about it. There is all this fighting going on, and then there is this attack that is going on, and then suddenly a plane crashes in India, Boeing goes down, and now you have this thing coming up. So feel free to have in your mind that this market is going to be very, very volatile. And don't look at your account. If you are a long-term investor, just shut down that app and focus on your work. I think that is better for a lot of us to do, and leave My Time Equities team to focus on your portfolio. Next slide. Performance of our markets, of our models in the market. So S&P was down for the week, as I mentioned. Our models, which are the custom models on the right hand side, where most of our clients are, except for the very smallest account, which is high risk, high equity account, that took a bigger beating of 1%. But if you look at the custom IBKR and the margin accounts, they were very steady compared to the S&P 500. So we did pretty well vis-a-vis the market, and that is because we are a very well diversified portfolio. In our custom IBKR model, we have growth, which is on the left hand side. You see all the individual models. So our clients get the opportunity to decide themselves as to where they want to invest their money, or they can tell us what they want and we can decide how to manage their money. So there are both the options. So if you want S&P growth, out of S&P's 500 companies, we have chosen companies which only grow. So if you look at the year-to-date numbers of S&P 500's growth model, we are at 5.77%. Where if you look at S&P's all 500 companies model, they are at 2.2%. So if you see the numbers, our growth model has really done well. Not only growth, if you look at our value model also, our value model year to date is 4.42, and S&P 500's year to date is 2.2. So already half of the year we have beaten the S&P by almost 2.2%, the value model. And same applies to blend, same applies to the innovative companies, which is in next generation. Then we have the small cap. Small caps have underperformed, as I mentioned to you in the previous slide, but that is where a lot of opportunity exists. But again, the opportunity comes at a price. Now look at metals and crypto. Metals and crypto has been up like crazy. It was almost 23% last week. This week it is no, not last week, the week before that. This week it is almost 16.71%, the year to date numbers. So if you compare it to S&P 500, these numbers are humongous. That is because gold and Bitcoin has really done well. Silver and Ethereum has done well last 2 weeks. That is also there in our models. Then international has performed very, very well, because when there are all this tariff thing going on, a lot of money went to Europe, Germany, Japan, India, Thailand, Indonesia, Turkey, Greek, all of these countries. So there are a lot of these countries in our model, right? So you have opportunities to invest directly in this model. So if you're a long-term investor, you say, look, I'm 40-year-old, I've got $500,000. Let me just put it in the growth model and sleep over it. Let me not think about this, right? We still manage it, but we will not be, diversifying it into international and gold and crypto and all that. But if you tell us, look, I want 30% growth, I want 20% international, we can also create a custom model for you. We are very, very agile that way. Now, coming to the right hand side, if you look at all the individual stock model, these are the models where all these models have only individual companies. You have Tesla, you have Palantir, and all of these different companies. On the models on the left hand side have only ETFs, low cost ETFs, but the one on the right hand side have only individual stocks. What does individual stock give you? Individual stock gives you, clarity, because they are all subject to only that category. Like AI and tech means only artificial intelligence and technology. High beta means the ones that are high beta stocks, beaten down stocks. All weather represents, all types of companies which are growth and little bit of blend and little bit of, different sectoral energy companies and things like that, not just tech. S&P Select 10 is, we have selected 10 companies out of 500 companies which we think can outperform the market, and you see it has outperformed the market. It's 5.56% up versus S&P is 2.2. And S&P 25 represent 25 of the S&P 500 company that has taken some beating. Maybe 2-3 companies are overweight on some companies that fell. Then Nasdaq 15, then technical upticks and Trump stocks, and so you have variety here, and you can decide to pick something from here directly, or we can create a custom model for you. And that is all we do, day long. We just do research and try to update these lists and try to generate as much as return as possible for our clients, at the same time protecting the downside, for our clients. Now, the reason why you see, the year to date for the custom models below the S&P 500 is because we did not participate in the V-shaped recovery. When the stock market went below the 200-day moving average, we took almost 50% of the money and parked it in treasury. And when the market came back, we missed 2 days of rally. So that is why you see a little bit of down numbers versus the S&P 500. That's always the case. If you are trying to protect the downside, you will not get the fullest upside. But then we have to look at these numbers for the full year, right? You will have to give it the one full year to see these numbers, and then say whether your models are really doing good on upside and downside both. Now, one thing I would request for those who manage your own money, if you think you are doing a great job managing your own money, my request to you is to take your statements and look at what has been the performance of your individual portfolio versus S&P 500, right? What you see here is that, right, we compare ourselves to S&P 500 because S&P 500 is the market, is the main hurdle rate for us. That is the rate which we try to compete with, right? That is the player that we try to compete with. Now, all of you, whoever is managing your own money, or stocks, because it's easy to buy stocks, sell stocks, but most of the time it goes by FOMO, right? You buy and sell based on what news says or your friends say, or you just put it there and leave it alone. You don't even look at it. Even that is a okay model, but you have to be little active while putting money in these equity markets, because as I said, there are too many players, including hedge funds, wirehouses, and all of that. So it is very, very important that you observe, research, and be in the game and play the right game. So please look at what has your performance been from last 2 years or 3 years or 5 years, so you get to see the numbers. So you're not making an emotional decision or a cost focused decision. Oh, I don't need a financial advisor. They charge me a fee, whereas I can buy the stocks myself. I don't have to do any of this shit, so why don't I just, just leave my portfolio alone? But my request to you is, analyze your portfolio, see how you have done over the last 4 years, and based on that, take a decision whether to actually be in the equity markets, or whether to be all in real estate, all in ventures, or all in treasury, or whatever it is, based on your risk profile. Next slide. Next slide, Jyoti. Okay, so let's now look at what structured notes do we have uh, on the shelf. By the way, this week a couple of our income notes got matured. All our clients made close to 1.5%, 2.5% per month, as the structured note had promised in terms of income. So for those whose structured notes are maturing, you have these options, plus we are also looking for more options. So here we have an option where we are buying a note where the underlying stock is Robinhood, and this is a fixed income note. So this note generates fixed income for you. So there is no barrier or no condition. You just get your 1.58% every month. Okay, but the underlying stock is Robinhood. It's a very strong company with strong fundamentals, with huge potential for growth, because they have adopted technology very well. They are buying and selling cryptos through their platform now, and all of that has taken the company's current share price in the 70s. So it used to be around $8, like 4 years back. When they launched the IPO, it went to 55 or 57, went down because of the 2022 crash, and now it is at almost 70. So this is the stock that is the underlying stock for this note, and the monthly income per month is 1.58%, and it's a 18-month note, but it can be called and your money can be returned at some point. So 6 months the banks cannot return the money, but after that, the bank can return the money. So your note will be cut short to 6 months if they return the money, instead of going all the way to 18 months. These notes are very liquid. If you want to exit out of it anytime, you can just inform us and see what the market is and take your money. But otherwise, this is a good high yield note, because the underlying company is a very volatile but a fundamentally strong company. On the downside, it has a protection of 50%. That means at the end of 18th month, if it goes all the way till there and it is not called by the bank by end of 6th month, then you will basically be looking at loss of capital if the stock goes down more than 50% at the end of 18th month, 50% from the June 18th price, right? So whatever happens in between, you don't have the impact of that. So there is a high upside of 19%, and the downside applies to you only if the stock is below 50%. That's the Robinhood note, and this note has to be traded before June 18th. The minimum is $25,000 for existing clients and 50,000. So if you want to start your journey with MyTime Equity, please talk to us. We can always make exceptions to those numbers. Thank you. Next slide. Next slide. Okay. So this note, the underlying stocks are Nvidia, Palantir, and Tesla. This is a principal protected note. So in this case, you don't lose your principal. Even this is trading on June 18th, and there is a good upside on this note, and it's a 5-year note. We have talked about this in the previous webinar also, because this was there last time as well. So very good note because of all the strong companies, and it's principal protected. Even if all the three companies go down by more than 50%, 60%, 10%, 20%, your money is safe. And on the upside, you make the principal and 11.5% return 12 months from now, and after 18 months, you have potential to make up to 17.25%, and it keeps going up like that 5% every year, and the maximum upside that you can see is 57.5%, you know. So that is how this note works. If you have any questions, please type them in the Q&A box, and we'll take the questions after the presentation is complete. Next. So we have the third note, which is the growth note. This note, the underlying assets are Apple, Microsoft, and Nvidia. This is a 3-year note again. Bank cannot call this note. The trade date for this is June 30th. So we have some time there. And the minimums, the bank, all of them are the same. The way this works is if you invest $100,000, you know, after 1 year, if the price of all these 3 stocks are same or more, you make 35% return, which means you get your 100K plus $35,000, $135,000. And if it is not called because 1 or more stocks are below the trade date price, then it goes to year 3. And in year 3, you get, you know, what X is it? 3X? 3X, yeah. So you get 3 times of the lowest performing stock. So, you know, let's say Apple is the lowest performing stock. It has grown by 50%. You are looking at 3X of that, which is 150%. And if all 3 stocks are down at the end of 3rd year, then you lose money only if all the stocks are below 50% from the June 30th, 2025 price. So this is a growth note. So you have a potential to make 35% at the end of 1 year, or you have a potential to make 3X of the lowest performing stock at the end of 3rd year. Next slide. Okay, so we have these options, which I think are great options. I am personally investing in these, and that is because, you know, these are high growth notes, you know. So we have multiple ideas here. Now, what does this mean, right? So here we don't have income, or we don't have return after 1 year. But here what is happening, if we invest in, let's say, the Palantir and RTX Corporation note, so at the end of 3 years, you get 5 times of the lowest performing stock. So if Palantir is up by 100%, you make 500%. If Palantir is down by 30%, RTX is down by 20%, you get your money back. If Palantir is down by 50% or 60%, you get only 40% back. So the rule on the downside is the same. First 50% no loss, below 50% you lose. But on the upside, you have 5X on the first note. The second note is with Robinhood and Nike. It has a return of 4X at the end of 3rd year of the lowest performing stock. And the third one is Broadcom and Eli Lilly. You know, this has a 3X return at the end of 3rd year. So these notes, we have not yet fully given our commitment to the bank. There is a potential for us to get a slightly higher return or a lower return. We have commitments for all the notes, but for us to really launch all the 3 notes, we need more participation from our investors. So if there is interest in any of these, please send an email to wealth@mytimeequity.com, or just type it in the message box and we will make a note of it. We will assume that you are seriously interested, and we will bind ourselves to getting the note launched. We may not launch all the 3 notes. We may launch 1 or 2 or all notes. We don't know. It all depends on you know, the participation, because we need $500,000 minimum participation in each note, which means as a company we need to commit to the bank $1.5 million total between the 3 notes. So if there is interest, please let us know. It will help the entire community of our clients. Next slide. Okay, I think this is the last note that we have. It's not in the format that we usually present because this just came hot off the press, and we thought we'll show it to you guys to create more options and to create more confusion maybe for you to decide where to invest. So, you know, this note, the underlying tickers are Lulu and United Health and FICO. Again, all 3 solid companies. This generates a 20.65% income every year, and it's paid monthly. It has memory. It has 6 months of no call, which means banks cannot return the money. Otherwise, they keep giving you, 20.65 divided by 12, which is around 1.9%, which keeps coming to you every month. And good note, and minimum is again $25,000 monthly income. Next slide. Next slide, Jyoti. Okay, so this opportunity is not an equity opportunity. This is not the stock opportunity or a structured note opportunity. This is more of a daycare building that we are finalizing. This is in Texas. It's in a city called Granbury, and this is a 1.6 million dollar building, and the income coming out of this building is around 120K. And the overall return looks very promising. It's a small asset. We already have commitments for almost 80% of the building. So if you want to participate in this, reach out to us. Again, wealth@mytimeequity.com, and tell us if you're interested. We can give you a complete dump on how this works, and you can participate in this. Again, real estate is not liquid. When you buy, you're putting your money. You get your money out only when we sell. It's not like structured notes or stocks or some of the private credit funds or infrastructure funds that we have. This fund is a longer hold period. You have to hold it for at least 4 to 6 years. But for long-term investors and for those investors who don't need depreciation on the building for writing off against your income, this is a great opportunity. It's a very strong brand that is the tenant of this building, and daycare businesses have done very well. And even during COVID, they did not lose income because government bailed them out. But daycare has been something like a very essential service, and it has stood the test of time. So reach out to us if you're interested in investing in this. And we don't invest in the business, we only invest in real estate, and we get rental income from the tenant. And the lease with the tenant that we have is for almost 14.4 years. So it's a long-term lease with a very, very strong tenant. It's not like one of these small Montessori owned by a few individuals. This is a corporate tenant, one of the largest daycare brand. So we look at all that, make sure that the asset is stable, tenant is stable, strong balance sheet, and all that due diligence is done, and it's a very strong asset if you're interested in participating in it. There is a cash flow of almost 6%, and the projected IRR is about 17%, but it is a 4 to 6 year hold. So please keep that in mind. If you are not in for holding patiently, then this is not for you. So I think that wraps up our presentation. We are now open to taking questions. And please again scan the QR code if you are not part of our WhatsApp group, or send an email to wealth@mytimeequity.com if you want to communicate with us. Anup, we can take questions.
Yeah, thanks Sudhir for taking time on the weekend, especially to provide an update on the market and commodities, and of course share your analysis on the V-shaped recovery based on the historical trend. You also covered on the prominence of hedge fund in today's market condition. That is something that we request our clients to have a look as well. Also highlighted how our portfolio management team is working hard and of course smart as well, especially with a few of the YTD numbers that is speaking for itself. Especially S&P growth has done more than 2 times that of SPY. So thanks for that. And now coming to the question, there are a few questions here, relatively higher number this week. The first question is, does any of your portfolio have a stock replacement? And if so, what is the cost of the premium? I think they're talking about the private exchange or something like that. So there, yeah.
No, what's the question? Can you repeat that?
Yeah, does any of your portfolio have a stock replacement, or like somebody has Coke to Pepsi or stocks to option strategy? If so, what is the cost of the premium?
Okay, I am not sure whether we do any of these stock replacement in our core models. As I said, we are long only investors. We don't do any derivatives or options trading or hedging using costly options. But if you are talking about something like an exchange fund, where if you are having single stock concentrated position, let's say you have a lot of bunch of Nvidia stocks because you work there. Now we have a fund where you can contribute that to the fund and become part of the diversified S&P 500 type fund. Or if you're speaking about something like tax loss harvesting, where we sell the loss making stock at the end of the year to take the benefit of tax loss harvesting. Yes, we do tax loss harvesting at the end of the year. If that loss makes any difference to you because you are a business owner, and if you're planning to sell your business, and if you want to take the loss from stocks against the gain from the sale of your business, all of that, it helps. Otherwise, just selling the loss making stock and not having any use for it today or in the future does not make sense. It increases transaction cost. So we have all the options, but we really are not traders. We just don't buy and sell and try to time the market, because one thing that we have learned is nobody can essentially time the market. Even Warren Buffett is not able to time the market. The hedge funds are not able to time the market with so much of data. So after all, we are all small fish in the big ocean of equity markets. So we do technical ins and outs to get a slight bit of alpha or protect from the downside. But other than that, we look at purely fundamentals of ETFs and individual stocks.
Okay. Thanks, Sudhir. The next question is, yeah, great study on the V-shaped recovery. So if the understanding is right, it is expected that market might go, a couple of percentage before potential current correction. Now the question is it worth to go cash or stay put?
So, again, as I said, nobody has a crystal ball. Nobody can time the market. We saw, a big drop in the overnight market on Thursday, but in the Friday morning, the market kind of came back 70%. But during the day, it was super volatile. So, telling whether you should be in stock or telling you whether you should be invested is a very difficult question to answer. But what I suggest is be invested in the market if you're a long-term investor. Trying to get some extra points means you may also lose those extra points or the points that you already made. So that is a very expensive lesson that I have personally learned as well, because as most of you know, I am not a wealth advisor by professional experience. I started this business just about 4 years ago, and started managing my own portfolio models for my own money for last 3 years. And I have done all these things, right? I have done trying to go in and out of the market when you are scared of the downside. But then what I have seen is we have not really done very well compared to S&P 500. So, but at the same time, it also means whether how important is this money for you in the short term. Money is always important for all of us, but how important is it for you 1 month from now, 2 months from now, 6 months from now, 1 year from now, 5 years from now? So we need to look at that. If you are in it for more than 1 year, then I don't think you should really play the game of trying to generate more money by doing this, unless you are trained for it. You sit in front of your 3-screen monitor and watch the volumes going up and down, see the technical trends, and then play that game. But seasonality is something important. While 2 years the V-shaped recovery have performed like that, you also saw that in 2020 the V-shaped recovery took a 10% correction, and it came back up very quickly, and then it went sideways. So there is no hard and fast rule here, right? Anything can happen at any point of time. But one thing I would like to tell all the listeners here is we are in a 43-year secular bull market. If you see the chart of last 50 years, you will see 43 years of just upside with some blips. You call it recession, you call it COVID, you call it Liberation Day, whatever it is. You look at the 50-year chart, all this looks very small, and the line is just going upside, right? But this, if you look at the 150-year chart, there is a potential break of the secular bull market at some point. August of 2025 marks the 43-year secular bull market. Okay, that means from 43 years, the market has only been going up, okay, continuously, with few years of some correction of 20, 25, 30, 40. But there will always be a bigger correction because sentiments of people is what market is. Okay, fundamentals are there, but as I said, S&P 500 is trading at 22 times of the net income. That means if you really have to make money from one of the companies of S&P 500 and it's 22 times, that means you have to wait for 22 years for you to get the income on your share, right? That is the valuation of these companies, 22 times. And that's a very high valuation. At 19 times is at best the best, but 22, 25, 40, all these are crazy numbers. So the market can have a pullback at any point of time because the long-term cycles clearly show that somewhere in 2026 or 2027 there could be a much bigger correction, and some bears say that it could be as low as 80% correction. Now who to believe, who not to believe is a big question. Bears will always be negative, bulls will always be positive. So that is where the whole analysis of understanding fundamentals, reading through the technical charts, reading through the macros, understanding all this is a lot of time and energy. So my request to you, if you are putting money in the markets and trying to manage it yourself, either be a trader or be a long-term investor. Don't try to be in between, because that is not going to help you at all.
Yeah, thanks Sudhir for your analysis again. The next is what is the nature of the risk on notes with current market, and during the period of notes would be effective. Since the notes are linked to its underlying stock, how to assess the risk with investing in notes?
Yeah, so that's a great question. Now, as I said, the market is open to unlimited upside and unlimited downside. But if you look at our notes, we have unlimited upside with a limited downside, or you have no downside in principal protected note with a very limited upside, right? And third one is income. Now, those who want income are a different category of investors. Now, income, you need income if you fall in these categories. One, you just want income. You feel good when you look at income. You say, great, I'm making so much income every month. But then when you look at your tax return, you see, oh man, I'm making $500,000 and I'm paying so much tax to the IRS. Why should I be paying so much tax? I want to do tax planning. Now my question is, if you're already having a problem with income, why do you need more income? Right? It's just common sense. But look at the entire 1 year numbers. Look at how your reaction is when you pay tax. Look at how your reaction is when you make that money, right? One time you're upset, one time you're super happy. But the question is, does it make sense to be upset and happy? So then the question is, why do you need income? Why don't you focus on capital gains type growth, right? So we have income and growth structured notes, which give you income at the end of 1 year, which is 30-35% if the markets are flat or positive, or a growth note, which is like 2x, 3x, which we showed with the Palantir and Hood and RTX and all that. Now, what is most important here with structured note is it gives you some predictability. While you are in a very unpredictable environment, with the big positive thing about AI and Bitcoin and blockchain and all that, saying, okay, the world will change, we'll all be millionaires, we all will make a lot of money because of technological innovation and blah, blah, blah. But at the same time, growth also represents huge downside, right? If you saw what happened with Tesla, with one tweet of Elon Musk, Tesla fell 15%. One DeepSeek coming out of China, Nvidia fell like crazy, like 10, 12, 15%. I don't know the exact number. So growth stocks, because they are so elevated in their multiple, can take a bigger hit when shit happens, right? So most important thing here with structured note is predictability. What is happening? Because my price is fixed. When I place the trade, that is my price. I just don't care what happens after that. Am I flat or positive? I make so much. I make income, I make flat income at the end of 1 year. Now, if it is more, If it's a growth note, you make 2x, 3x, 5x, or whatever the note is. So the way I usually look at my personal portfolio is like this. Okay, I like Palantir. Do I like the valuation of Palantir at some crazy, 80, 90x or 900? I don't know the exact P of Palantir, but it's just crazy. Palantir and Tesla are just crazy. So, but I like Palantir. When we did the Palantir note, it was $66. We did an income note. Now, if you look at that income note today, you will say, man, I lost all that gain because Palantir is $137 today. It's gone more than double, right? What did I give you when I gave you the Palantir note 1 year ago? I gave you peace of mind. I gave you income, which Palantir won't give you. And then, it was just an 18-month note, right? You're not binding to it lifelong, right? So those are the advantages of the structured note, and the minimums for the structured notes are low. So the way I look at my portfolio is, if I want to be in one of these companies, then instead of just buying that, one stock, I'll put it in this note to the same extent, and I relax. I sleep well at night without even having to log in my account, because I know I have protections on both sides, right? Or a huge upside with a growth note. So that is how you look at structured note. Structured note is not for all your money, and structured note is not for nothing in your portfolio. It should be in your portfolio, and that is where we come into picture, right? This question is great, but how much this question really helps you in figuring out a solution for your personal net worth, your personal financial plan, is something I think will make sense for you to directly talk to us and explain us your situation, and then we can give you an answer.
Thanks, Sudhir. I think a related question is, I typically receive several emails from financial advisors offering different investment portfolio and commission rates. How is MyTime Equity different from other financial advisor?
So as I said, I am not a financial advisor who was supposed to be in the business of financial advisory. I was a good long-term employee of Infosys Technologies for 11 years. Worked very hard in one company. Then I started tax business, did a great job managing taxes for almost 25,000 people. And then today we are in this business because, I always try to solve a problem. And this business, I started to solve my own problem, because I went to a lot of financial advisory firms. They just didn't do anything. They just invested money and they said long-term investment, and there is no changes at all. Whereas today with my team, we look at 50-day moving average, 200-day moving average, 21-day moving average, volume, which sector is doing well, which country is doing well, which commodity is doing well, all of that, right? And end of the day, you need to be in the asset which is performing. And last but not the least, most of the financial advisors won't even touch Bitcoin or any crypto. We go with the trend, right? We see what is trending. While you may be a technology expert and you may know everything about technology, a doctor may know everything about medical technology, we bring the flavor of every other sector. Should you put it in energy, or should you put it in crypto, and how much weightage should you allocate to each one of these, right? So that is one big advantage with us. Second advantage is alternative investments. You will not see any financial advisory firm giving you this many alternative investments, whether it is private credit, private equity, hedge funds, real estate, ventures, and all of that. Third, we are masters of tax, right? We can help you with tax reduction, tax saving, tax deferral, Roth IRA, traditional IRA, defined benefit plan, all of that, right? And then last point is owning properties directly, right? Which financial advisory firm will help you with buying a building which is a daycare building, right? So most of the clients who come to us are really coming to us because they want solution to their problem. They don't compare us to others at all, because there is nobody else in comparison to us. And I'm not bragging here, it's just because I know, and I've tried to find another company which can help me with my own money which I have earned over the last 25 years, and I didn't find a one firm out there. I went to UBS, I went to Goldman Sachs, I went to JP Morgan, all of the big firms. They give you a lot of benefit. They'll give you free credit card, free this, free that. But what about money management? What about planning? What about diversification? All of that, nothing. So that's what we do.
Thanks, Sudhir. Additionally, we cater to all sectors of our clients, irrespective whether non-accredited, accredited. qualified investors or qualified professionals also. So that is
Yes.
other advantage that we have got, right? Because most of the
And our
firms,
limits are so low.
correct, and most of the firms might not even look into anybody less than QC, QI kind of thing. Okay.
Correct.
Thank you. And could you expand on how the individual portfolio would be managed in our name or in a broker account or as a fund with you or both? We have Charles Schwab account for that, right? It would be under your name, right? And
Yeah.
we would
Yeah.
be
Through
custodian.
active management through Interactive Brokers. We do all alternative investments and little not so active portfolio in Charles Schwab. And then buying any other direct real estate and all will be, we set up an LLC in your name and you buy it in that LLC and you are the owner of it. So again, it's all custom made. It depends on, how much money you want us to manage and in what, right? Yeah.
Thanks. But yeah, you will have access. Every individual will have access to their account. They can log in. They can check, every single day. Okay.
Correct.
Yeah. And then is Tesla a good bet for 5 years considering the volatility?
Well, Tesla is a very great stock because Elon Musk is behind it. It is the future of EV, but at the same time, it's a very volatile stock. And the most intelligent guy is also the most craziest guy. We saw that. So, again, it's a great company. The question is, do you put all your money or do you put 1% of your equity or 5% of your net worth? That's a question that you'll have to figure out based on your individual risk tolerance.
Thank you. The next is there liquidity for two stock growth opportunity note? Yeah, it is. Liquidity is always there. Whenever if there is an emergency or there's a need to sell, do let us. We can help to what extent it can be liquidated before the term ends. Next, somebody wanted to ask about how does daycare, is it eligible for 401k? So I'm assuming it is old 401k, right?
Yeah. If it's a old 401k, which your employer will not stop you from investing, which means we have to roll it over into an IRA. We can do it through old 401k or IRA. Yes.
Okay. And the next question was, is there a concept of imputed interest on the growth notes?
There is no imputed interest on the growth note because the returns are like huge multiple. So if you saw the Palantir and RTX note, the return was 5x at the end of year 3. So there is no imputed calculations. It's straightforward calculation.
And is there a K1 at the end of the year for structured notes investment?
No, it is. It directly comes to your brokerage account. If it's income, it's regular income, like 1099 income, or if it is growth, it is like capital gains.
Out of capital gain, yeah. For Hood, would we get income irrespective of the stock value irrespective of the stock value during the note term? Answer is yes, it is a fixed income. So as we mentioned in the flyer, you will get 1.53% every month, tune up to 19.1% annually. Okay. Next is thanks for the great answers and details. I would like to connect with you. Available this weekend or next week in the evenings. Yeah, please send an email with your preferred time. We'll also see our calendar mutually, and then we can agree on a time and the date. And I think we are almost 4 minutes past the hour, so if there are any questions, do reach out to us. But Sudeep, thanks once again. Jyoti, thanks again, and all the listeners who joined on the weekend. Okay. Thank you.
Thank you, and happy Father's Day to all the fathers here.
Thank you, Sudhir.
Bye.
Thank you. Bye-bye.